welcome to Global Mantra Outlook 2013, a special show that profiles prominent fund managers from the City of London and gets their views on the global market environment. Joining me on the show today is Richard Titherington, who's the Chief Investment Officer at JP Morgan Asset Management. Richard, it's good to have you on the show. Thanks very much for taking out the time.
Pleasure to be here.
Let's begin by discussing how you see the world in 2013, world markets essentially. Starting off with the risks coming in from Europe, because that was a key overhang all of 2012. Will the euro survive or not? Do you think that those risks have settled? Because one of your earlier comments was about how you're not completely out of the woods in Europe.
Well, I think you can tell the way markets have performed over the last couple of months that investors are more relaxed about the outlook for Europe than they were, let's say 12 months ago. But clearly Europe hasn't solved its problems. I think the ECB is doing everything it can to reassure investors that we won't go into a crisis environment or we won't have significant banking failures. But the structural issues around how do you promote economic growth within Europe still need to be addressed.
What, to your mind, are the key risks in Europe right now? Do you think the question of will the euro survive, is still legitimate?
Well, I've actually had a number of meetings with our clients in Europe recently, and I think the consensus amongst them is that the euro will hold together and that ultimately Germany will pay the price required to keep the euro together. So I think the risk of the euro breaking up, which people thought was high at the beginning of this year, will be much lower in 2013, and I think that's a positive thing. We will probably have periods during the year when investors do worry that there will be a euro breakup, so I clearly don't think that the issues have all been resolved, but I think that Europe will be less of a factor in investors' minds in 2013.
About 2012, there was a lot of nervousness regarding the Eurozone, and the markets actually ended up doing well across the European region. In the US, on an average, markets gained about 10% plus. The emerging markets have done well for themselves. India's had a great year. Germany has had a great year. The euro has strengthened. My point is, could there be a sell-on-news kind of a situation coming in 2013 because there is a sense of complacency that things are not going to get bad from here?
Well, I think I'd put it the opposite way around. I mean, clearly markets have gone up despite the nervousness and pessimism, and you might even say because of it. Generally when people are nervous, it's a good time to buy. Now, yes, people are less nervous today, but if you look at what investors are doing, far more money is still flowing into bond funds than into equity funds. So I don't think we're anywhere close to euphoria. So if we think about a scale from fear to greed, we certainly haven't reached the greed or euphoria stage. So I don't particularly see why 2013 would be a worse year than 2012.
Would it be a year of risk on?
Well, I hope that we move out of this environment of investors switching on a very short-term basis from risk on to risk off. I mean, if you look over 2012, people have switched on more or less a monthly basis. So I hope we move out of the on-off cycle. If we don't have a recurrence of the Eurozone crisis, and if America does continue to improve, I think in general, yes, we will be in a risk-on type environment.
Even if the pressure to step up on austerity builds in the Eurozone?
Well, I think austerity on its own isn't going to solve the European problem. There has to be a growth strategy, and I think governments are still debating amongst themselves how to do that. I don't think there has to be a growth strategy in place by January 1, 2013 in order to reassure markets. I think what markets are going to focus on during the year is there positive progress? Are we moving in a... Markets always care about the trend, as you say. It's the trend rather than arriving which drives equity markets, and if we see a positive trend, I think that'll be enough.
What would that mean essentially for the key currencies, the dollar and the euro? Because the euro has shown relative strength this year. There is an expectation that we would see some safe haven buying in the dollar. Again, pertaining to the risks regarding the fiscal cliff. What happens with these two major currencies?
I have been surprised this year by the relative strength of the euro. It does seem to me logical over time that the euro should weaken. Now, I think there's a question as to what it weakens against. And you might argue that the US has been more effective than the Europeans in weakening their currency over the last few years. When I look at the world from an emerging market perspective, I think it's likely over the medium to long term that all the major currencies, the dollar, the euro, the yen, all weaken against a basket of emerging currencies. But on a shorter term basis, I would expect the euro to weaken against the dollar.
All right, Richard, we'll talk a little bit more about the emerging world and what emerging markets are slated to do. Let's discuss the emerging world for 2013. What's the expectation there? Because it's been a decent year. And where do you see the outperformance really coming in emerging markets, essentially?
In the emerging markets themselves, I think the concerns that we had over the last 12 months about growth rates in places like China and India, inflation rates, are going to be significantly less of a concern in 2013 than they were in 2011 and 2012.
Why is that? Do you think it's because these risks have already been accounted for in the price?
Certainly that, but also I think there's quite a lot of evidence that the Chinese economy is turning around. I think there's evidence that inflation is coming down in India. So the broad trends of growth recovering and inflation coming down across the emerging world, I think are very much in place, and that's a positive outlook.
How much would the price of oil be a catalyst for a further build-up or a further rally in emerging markets from here, especially for the ones which depend on oil?
Well, obviously some countries, India's a good example, Turkey's another example, are pretty sensitive to the price of oil. So if we get a dramatic move in oil prices in one direction or the other, that'll clearly directly impact.
Do you expect that?
Prices. No, I'm not expecting it, although I don't have much confidence in my ability to predict commodity prices. I think oil prices will continue to fluctuate, but within a relatively narrow band.
What is your outlook on how China will be able to manage its risks?
I am very much in the optimistic camp about China from two perspectives. One, from an economic perspective, I think the Chinese economic story has still got a long way to go. Just because China's a large economy now doesn't mean it's reached any significant level of maturity. And I think that China will continue to grow far more rapidly than the rest of the world for decades to come. So I'm an optimist from an economic standpoint, although there are many challenges. I also think that because of the skepticism about China, Chinese equities are unusually cheap. So clearly the new generation of leaders have a lot of issues to deal with. As the economy grows, it becomes more complex. So there are serious problems, but in general, those problems are already priced into the equity market. Okay. And that's a positive thing.
So you think the 3 years of underperformance the Chinese market has shown relative to other markets, you think that will change in 2013? You think the Chinese market will pick up?
Well, certainly our funds are overweight China, so our expectation is that that's going to happen, and it's starting to happen now. And as you say, we've had 3 years of underperformance. 3 years ago, everybody was terribly optimistic about China. Now everyone's terribly pessimistic about China. And as an investor, you want to be trying to move the opposite way to the crowd.
Do you think that, as we speak today, the risk of China facing a hard landing has been averted?
Yes, I do. I think clearly the cycle is beginning to turn. with the new generation of leaders coming in, I think you'll see a far more active approach from the government over the next 6 to 9 months than you've seen in the last 6 to 9 months. So I think there's very little risk of a halt.
A large part of the trade that's done in emerging markets, especially the equity markets, is also a currency play and getting the currency right, because investors tend to lose money otherwise. How do you manage that risk for 2013? Because you are saying that it'd be volatile for EM currencies.
Well, as you say, emerging market currencies have always been volatile. I think that will remain. I don't think we are close to maturity for most of the major economies, and therefore the currencies will remain volatile. We do quite a lot of work on the valuation of currencies. And in broad terms, our view is that commodity-related currencies are on the expensive side. So when you look at the ruble or the rand or the Brazilian real, they're modestly overvalued. And what you might call the industrial currencies or the consuming currencies, the Korean won, the Indian rupee, are undervalued. So when we think about long-term returns, we're factoring our view of the currency into our expectation of returns.
And what are your return expectations from the new year?
Well, we tend to think on a longer-term basis. So from current valuation levels, I would expect over the next 3 to 5 years, you should get somewhere in the 14 to 18% annualized returns from emerging market equities. Now, that doesn't mean you're going to get 14% each year for the next 3 years. But next year, when we think about 2013, that's a reasonable number, I think, to have in your mind.
Would it mean also that for the new year we might look at a lot of markets touching fresh highs and perhaps trading beyond?
Yes, I would expect so. Yes, certainly in local currency terms. I mean, we would expect India to reach new highs in local currency terms. But again, the big issue for the foreign investor looking at India is the currency.
Let's talk about, do you think that going forward into the new year you will be increasing allocations to India despite the rally that we've seen so far?
Well, we moved in general from being quite significantly overweight India to a more neutral position. So right now I think the outlook for India is in the balance. Some of the good news has been priced in. There seems to be some movement on the political side, which I think is encouraging. If Indian equities fall, for whatever reason, I think that would be a buying opportunity. If they continue to go up, my natural tendency would be more to sell.
From a valuation perspective, how does India look to you?
It's about neutral compared to the rest of emerging markets. It's lower than it's been in the past. It's not as cheap as China is, for example. I mean, I think amongst the big markets, China is clearly the cheapest right now. But I certainly don't think in aggregate the Indian stock market is expensive, despite its quite good performance.
Do you think that the corporate earnings or the slowdown that we're seeing in the economy, you think we have pretty much hit a bottom in that cycle?
I hope so. Although, as I say, I think corporate India is still quite pessimistic. But I think that the economy has probably bottomed, and I think 2013, from an economic standpoint, will be better than 2012 was.
Has the market priced that in, do you think?
To a certain extent. I don't think the market in general is euphoric in any sense, but I think they are expecting improvement.
So the story in India you see is, the market's touching fresh highs and perhaps trading beyond, or there could be an element of euphoria which would then get sold into?
I think the market will touch fresh highs, and from a foreign perspective, I think actually the biggest swing factor in India is going to be the currency. The Indian market, from a US dollar perspective, is well below its all-time high, And I would expect actually greater volatility around the currency in 2013.
You think the balance of risk has shifted there because for a lot of foreign investors such as yourself, even though the flows in India have been net positive, because of the currency movement, the net returns have not really matched up. So to that extent, do you think for the next 12 to 18 months, the currency play would be favorable?
When you're starting from an undervalued position, that's a good place to be from a foreigner's perspective. Now, it doesn't mean it's necessarily going to go in my favor in 2013, but we are starting from an undervalued position, which gives me comfort at least.
The political transition that we're seeing in India, you spoke about how the noises were encouraging. Are they convincing, though?
Are political noises ever convincing? I think there is a sense in the government that we've got a fairly short window before the next elections are due. Unless we do something positive, we're highly unlikely to get re-elected, and in general politicians are pretty sensitive to their re-election prospects. So I think the government will be far more proactive in 2013 than it was for most of 2012. Whether they do things that I like is a separate question.
Would that get reflected in the budget as well, you think?
I think so.
Okay.
I think so.
What are your expectations from the budget from purely a market standpoint?
Well, as I say, I think the government will increasingly be focused on what do we need to do in advance of the election in 2014. And really that comes down to boosting growth, boosting employment, and boosting rural incomes. So I would expect, although I'm not a political expert, I would expect the budget to be focused on those three factors.
So you expect a reformist budget or a populist budget? Because it's going to be a bit tricky, or whether they should make the right noises as far as growth and reforms is concerned to appease the industry and investors, the markets, or do what is required to maintain their strength at the center?
I would expect a pro-growth budget, and I think any reform measures are going to be aimed at stimulating economic growth, and the government will try to portray them as being populist measures, as being job creators. I think that's the key issue.
How much can a potential rate cut at the start of 2013 change the dynamics or change the way you're looking at investment opportunities in India?
My expectation will be that the central bank will want to see further evidence that inflation is coming down before they do anything. If they were to make a cut at the beginning of the year, again, I think you'll have a difference between the local market's reaction, which I think would be positive, and the currency's reaction, which could well be negative. So my preference is stability, but clearly, when the central bank feels it's comfortable to cut rates, that has to be a domestic positive.
What is it that you're projecting in terms of growth pickup for the economy?
Well, we're expecting growth to pick up. We're not expecting it to pick up dramatically. And I think that although, as I mentioned, I think...
Consensus says 7%. You think that's fair?
I think that's a reasonable number. I certainly would be surprised to see a lot more than that. And I think, as I said, the government is going to be talking a lot about growth in 2013. Their ability to move the dial in the short term is quite limited. So I don't see us going back to 9, in a year's time. But growth will improve, in my view.
Talk about investment opportunities in India. In banks, what is it that you like?
Well, we have a pretty strong preference for private sector banks over the government-linked banks, and I think that the trend of growing market shares amongst private sector banks will continue. We're pretty optimistic about financial services across the emerging markets. You know, they're in a very different place to the developed world, and India is a great example of that. Domestic banking, mortgages, you know, personal credit.
But PSU banks have not come on your radar, purely on the basis of value?
Yes, there's a valuation attraction. But I think you always have to recognize that there is a much greater emphasis on profit and profitability in the private sector than there is in the government sector. And you know, that's, you know, as an equity investor, I ultimately care about profits.
All right, Richard, we leave it at that. Thanks very much for joining us and sharing with us your views on India and emerging markets.
My pleasure.